The people who lost the most worked there. At one American company, employees kept about two-thirds of their retirement savings in a single stock, their own company's. They believed in it. They understood it better than any outside analyst ever could. They built the thing. And they lost almost everything. This is a video about the one rule that would have saved them. A rule about which risks the market actually pays you to take, and which ones it quietly lets you take for nothing at all. And you should care, because right now you might be making the very same bet. Maybe it's the hot stock everyone's talking about, or maybe it's the quiet one, your own company's shares, sitting in your 401k, feeling safe, feeling loyal. Let me show you the rule. Here's the whole thing, up front, in one sentence. The market pays you to take a risk you cannot escape, and it pays you nothing for a risk you chose. Owning one company is a risk you chose, and the odds on that bet are quietly, permanently stacked against you. Over the next few minutes, I'm going to prove all three parts of that, with the data on what actually happens to single stocks, with the simple rule underneath it, and then I'll show you the fix, the closest thing to a free lunch that exists in investing. That company was Enron, early 2000s, one of the most admired companies in America, a Wall Street darling. And the people who believed in it most were its own employees. Around two-thirds of their retirement money was in Enron stock. Then the fraud unraveled. The stock fell over 99%. It went, essentially, to zero. Employees lost more than $1 billion in retirement savings. And here's the cruelest detail. As it was collapsing, many were locked out of their own accounts during a plan change. They could watch the number fall on the screen. They just couldn't sell. The people who understood the company better than anyone on earth lost almost everything they'd saved. So why does the market work like that? Here's the rule. Once you see it, you'll see it everywhere. The market only pays you to take a risk you can't get out of. Think about hazard pay. A worker who paints a bridge 300 feet up gets danger money, because the job genuinely cannot be done from the ground. The danger is baked in. He's forced to bear it, so he gets paid for it. Now picture that same painter juggling knives on his lunch break. Is he in more danger? Obviously. Does anyone pay him a single cent for it? Of course not. That's danger the job never required. He could have just not. That is the whole thing. Owning stocks at all means taking one danger you cannot escape. The entire market can crash. 2008, the COVID plunge. Owning all 500 of the biggest companies won't save you from that one. A crash hits all 500 at once. You're forced to bear it, so the market pays you. And that pay is a big part of why stocks return roughly 10% a year, while cash crawls along at 3 or 4. But betting your savings on one company, that's the knives. It's danger the job never asked you to take. So nobody pays you for it, because you could have just owned everything instead. Now, the odds are against you isn't a feeling. It's measured, and the numbers are brutal. Start with the floor. A finance professor named Hendrik Bessembinder took every U.S. stock going back to 1926. He found that more than half of them, around 3 out of 5, didn't even beat a 1-month treasury bill over their entire lifetime. Not the market, a treasury bill, the safe, boring, cash-like thing. Most stocks lost to it. Then the stunner. Every dollar of net wealth the entire U.S. stock market has created since 1926, every dollar above what treasury bills would have paid, came from just 4% of stocks. Half of it came from 86 companies. 86. The other 96%, all of them put together, did no better than a treasury bill. Across all of them, the gains and the losses roughly canceled out. So when you buy one stock, you're not flipping a coin. You're reaching into a jar of 100 tickets where only 4 hold, basically all the prize money. And the rest on balance. Just hand you back what cash would have given you anyway. Maybe you think, fine, most stocks are junk, but I'll pick a normal solid one. Not a lottery ticket, just a good company. Even that loses. A 2023 study by Antti Petajisto looked at the typical single stock. Over a 10-year stretch, the median U.S. stock underperformed the market by about 8% total, and 55% of stocks were outright losers against it. That's the one in the middle, not the disasters, the median. And here's the part that should stop you cold, because it's aimed straight at the stock you're probably tempted by. Take the stocks that performed best over the previous 5 years. Exactly the ones people rush to buy because they're clearly winning. Over the next 10 years, the median one of those underperformed the market by nearly 2% every year. And since World War II, that median has been negative 93% of the time. Read that again. The hotter the stock has been, the worse your odds over the next decade. The very thing that makes a stock feel like a safe bet, it's been going up, is the thing that predicts it letting you down. And remember the rule. The extra danger you take by holding just one company, the part that would vanish the instant you diversify, is supposed to pay you nothing, and it doesn't. Averaged over thousands of tries, a single stock does no better than owning everything. And as you just saw, most do worse. You pay full price in risk and get nothing extra for it. Just look at the spread. A bad year for the whole index is a drop of around 20%. It stings, but you recover. A single stock can do that before lunch on one ugly earnings call. It can go to zero like Enron, or it can triple like the names people brag about at parties. A typical stock swings about twice as hard as the index. A hot one, far more. Its outcomes run from losing everything to growing 10 times over and beyond. Same average payoff in the end, but a vastly wider, scarier range around it. That's not investing. That's a casino bet wearing a suit. You're taking on a casino's worth of risk for a savings account's worth of extra reward. Except the savings account isn't even there. The extra reward is zero. By now you're arguing back, and I want to take your 4 best arguments one at a time. 1. I'd only buy safe, established blue chips, not some fraud. Fair. Take the safest stock you can picture, General Electric. For a century, the blue chip, light bulbs, jet engines, the stock your grandfather bought and told you to never sell. In the year 2000, GE was the single most valuable company in America. No fraud. A real colossal business. From that peak it lost about 80% of its value, cut its proud century-old dividend to a single penny, and in 2018 was thrown out of the Dow after more than 100 years. Safe and established is a very different thing from safe. 2. But my stock is up huge. It's clearly a winner. You just saw the data. The past 5 years' best performers underperformed over the next 93% of the time. Hot is not a plan. Hot is the warning label. 3. But I know my company inside out. So did Enron's employees. Better than any analyst. Knowing a company tells you nothing about the commodity shock, the lawsuit, the policy change, the fraud 2 levels above you. Familiarity feels like control. It isn't. 4. But somebody owns the next Nvidia. True, somebody does. But that's the 4% talking. You only ever hear from the winners. For everyone you can name, there's a GE nobody brings up anymore, and an Enron employee who doesn't get invited onto podcasts. That's a lottery ticket, not a plan. So how do you delete a danger for free? Here's the beautiful part, and it comes in 2 halves. First half, that boring index fund owned Enron too, and GE, and every company that ever blew up. The diversified investor didn't dodge the disasters. They owned all of them. But each was such a thin sliver that when Enron hit zero, they barely flinched, a rounding error on an ordinary Tuesday. Second half, the one everybody forgets. That same index also owned Apple, and Amazon, and Nvidia. Every giant winner, automatically, from day one, with zero guessing. Remember, 4% of stocks made all the money. A total market index fund guarantees you own that 4%. Because it owns basically everything. You don't have to be the genius who spotted it early. You just have to be there. So you survive every loser and you catch every winner. Own 20 or 30 companies and most, not all, of that single company danger is already gone. A total market index fund hands you thousands of them in one click for almost nothing. You keep the market's 10%. You keep every winner. And you throw away the one danger nobody was ever paying you to carry. Economists call diversification the only free lunch in investing. Now you can see exactly why. So here's something you can actually do tonight. Look at whatever single stock you're holding and ask one question. If that money were sitting in your account as cash right now, would you go out and buy this one stock with all of it today? If the honest answer is no, you're only holding it out of habit or loyalty or the hope of being right, and none of those is a reason the market pays for. One fair caveat: if that stock is sitting on a big gain, selling can trigger a real tax bill. So the move might be trimming it down over time, not keeping the bet forever. And the single most dangerous version of all is the quiet one, the one we started with. Your paycheck and your life savings, riding on the very same company. That's not one bet. It's the same bet, twice. So here's the whole video in one line. The market pays you for the danger you can't avoid, and nothing for the danger you choose. Keep the reward. Drop the risk they were never paying you for. It's the one thing in investing that's actually free.